Okay, so today I wanted to talk about something that a lot of people in this space are feeling right now, but not really saying it out loud. The market feels stuck, like nothing is moving. And depending on who you're listening to, you're either about to get rich or about to lose everything. But those things are actually true right now. And today I want to break down why, and more importantly, what you should actually be thinking about. So here's what's happening right now. And I think that most people don't have a name for it. It's called time-based capitulation. When people think about market crash, they think about a big violent drop. Everything goes red in one day, panic, selling, chaos. That's a classic version. But there is another version that is actually more effective, and that's just boredom. The market goes up 2%, down 3%, up 1%, down 4%, week after week, month after month. And eventually people just give up. They stop checking, they sell, they move on. That's actually what's happening right now. And it's not random. It's how markets shake out the people who don't have conviction enough before the next real move. Could we still drop to the 30 to 50K range? Yes, it's possible. But if it happened, it's not the end of anything. Every major Bitcoin bear market has been less severe than the last one. 94%, then 87%, then 84%, then 77% in 2022. A 70% pullback today will just be the next step in the pattern. It also means that the asset is maturing. For the next one, I want you to really understand, because it catches people every single cycle. In a bull market, you get sharp dip and then explosive recovery. Everyone learned to buy the dip. That's simple. But in the bear market, it's completely backward. The big institutional players, the fund, the large trader, they have massive position they need to exit. But they can't just dump everything at once. That will crash the price and they will get terrible file. So what they do is slowly walk the price up. Weeks, sometimes months, of grinding upward low volume. Retail traders see that and think the bottom is in, so they pile in and some use leverage. And then the institutions sell everything. And in a matter of days, months of slow gains are gone. Both sides get hurt. The bulls, so the people who thought that the price will go up, are trapped at the top. And the bears who were shorts got squeezed out right before the top. That's the cycle. And it plays out the same way every time. The tool change, the player gets bigger, but the behavior is the same because humans are still making the decision. And here's something that generally surprised me when I look at the data. The last Bitcoin cycle peaked on day 1062 from the micro bottom. The cycle before that, day 1059. The one before that, day 1068. And think about what happened in between those cycles. Global conflict, supply chain crisis, massive political shift, oil shock. But none of it changed the clock by more than 3 days. Why? Because the cycle isn't driven by news. It's driven by two things that don't change. First, the halving. So people who don't know, every 4 years, the amount of new Bitcoin created gets cut in half. That's hard-coded into the protocol. You can't negotiate with it. The second is human psychology. When supply tightens and the price starts rising, grids kicking, leverage build, and then it all collapses under its own weight. It happens the same way every time because people react to the money the same way every time. So as we said, the market is boring because the capital left. But so if crypto is leaving the crypto in the short term, where it's going? So right now, a massive amount of institutional money is rotating into energy, manufacturing, physical good, old economy stuff, oil companies, steel, raw material. And this connects directly to a shift in how central banks are operating. For the last 15 years, the system was top-down. So the central bank was printing money and sending it straight to Wall Street, to the big bank, to the hedge funds, to the asset manager, etc. The theory was that the wealth will trickle down from here. That model is changing. The new direction is bottom up. So push the liquidity into commercial lending, into everyday borrower, into the physical company, company that build real things. What that means for crypto right now is that the speculative capital that was fueling the market is being pulled elsewhere temporarily. That's a big part of why it feels slow. But here's the thing. Liquidity cycle always rotate back. When the real economy strengthens, wealth gets generated. And then that wealth eventually look for somewhere else to go. Scarce assets, high yields, etc. And I guess that is going to sound familiar. So Bitcoin is just sitting there, running its code, waiting for the cycle to turn. Finally, let me give you one comparison that I think reframed the whole conversation around risk. A lot of people think investing in something like the Russell 2000, which is an index of 2,000 small American companies, is safe, boring, diversified choices, traditional finance, low risk. And here's what's actually inside that index. Around 40% of those companies are unprofitable. They don't make money. They stay alive by constantly rolling over their debt. When interest rates are near zero, that's fine. But when the rate goes up, their debt payment explode and they start dying. Over a 10 years period, that index actually underperformed the big mature S&P 500 companies. So this safe bet isn't that safe. Now look at the top tier of crypto. No corporate debt, global liquidity, fixed supply, infrastructure being built around it every year. The risk profile look very different when you put them side by side. And I'm not saying this to hype anything. I'm saying it because a lot of people think they are being conservative when they are actually sitting on more structural risk than they realize. So to bring it all together, yes, the short term is uncertain. Yes, there could be more downside. The boredom and the slow grind is real. But none of that changed the underlying structure. The halving cycle, the fixed supply, the institutional infrastructure being built, the math that keep repeating across completely different market environment. The current discomfort is not a sign that something is broken. It's just what the transition periods feels like. And the people who come out of the other side are the ones who understand what they are holding and why. So that was it for me for today. See you in the next one. And all the athletes who wants to have more information and to start their digital assets investment strategy, the link in the description. See you on the next one.